When we look at the trade for the week, we actually lost about 12 cents or so on the corn and about 40 cents on the soybeans. And most of that took place today. Most of it happened today. And we would have been pretty much even going into this report. And then we had the big sell-off, the wheat down 19 cents today. And we look at the fundamentals, price is still a function of supply and demand, but as modified by the flow of money. So I'm going to take a look because that does have an impact on how the market responds to this crop report. If we look at the funds, first of all, the CRB index, and I show this each time just as a reminder, there are 19 different commodities in this CRB, this basket of commodities called the CRB index. 39% of them energy, 23% is crude oil. Agriculture makes up 34%. Excuse me. And then we're going to look also at the continuous commodity index, or the equally weighted commodity index. 18% energy, 47% agriculture, and everything is designed to be equally weighted. Of course, that gets out of kilter during the year, and then in January of each year they rebalance it. So starting off with the CRB index, we see here that we've been in a downtrend since mid-May. And we have the double bottom that we put in the winter of 2016, and then another island reversal, bullish island reversal in late June of 2017. We rallied off of that. We've got this long-term uptrend off of those lows, but we've been rallying at a faster pace this year, really since the middle of last year, because of commodity inflation talk. Then when the trade war talk started in mid-May, I know the talk started much before that, but kind of for a while there, it looked like, okay, it's just talk. It isn't going to really happen. And then it became clear in late May, it's going to happen. You know, it looked like negotiations are going well, but China was unwilling to give in on the intellectual property rights issue. That was the major stickler. Didn't always get pressed that way, but that was the major stickler. And so President Trump doubled down and really started hitting them hard with tariffs. We actually had a break today. Very quietly, China, we're seeing news reports that China withdrew the tariff on some U.S. energy going into China. That tells me that they've blinked. In this poker game, this high stakes poker game, that they've blinked. So I look at that as a positive sign right now. Their economy is simply struggling too much. We'll talk a little bit more about that later in this webinar. But in the meantime, note that we've been in a downtrending channel. So commodity inflation has been set aside for a while. Earlier this week, we tried to probe above the top of that channel, could not hold it, and the selling returned, and we certainly saw that continue today as well. Crude oil found some strength today on a warning from the International Energy Agency that we could see higher crude oil prices and a return to volatility crude oil market as our sanctions against Iran start to kick in this fall. So that supported crude oil, and that may return the commodity inflation talk as we get later in the year. We'll have to watch that and see, but the dollar also broke out sharply. That tends to be a negative for commodities. So we're going to have to watch here in the days and weeks ahead how that all balances out. And of course, we'll be talking about it in future webinars as well. Now, all of this chart right here, this daily chart, is summed up in the circle that we see here on the right hand of this weekly chart. This chart that I first showed you goes back to January of 2016. This chart goes all the way back to January of 1998. So you can see that while it's been encouraging to see the inflation of commodities here of late, we're nowhere close to the bull market that we saw in the commodity complex 10 years ago. So long ways to go before those types of commodity bull markets tend to come along every 30, 35 years. I wanted to provide a little bit of perspective. This is the continuous commodity index, and note here the lows put in the winter of 2016, The repeat bullish island reversal put in late June of 2017, the trend line off of those two. But because of the weakness in the ags, and remember the ags are a larger portion of the continuous commodity index, we have violated that trend line support and we're below it. Now we've got a bullish island reversal right here. It's still yet to be determined whether that's going to hold. We almost closed that gap and negated it, but we didn't. So this is kind of on tepid ground right now. This is something we're going to have to watch closely to see if it breaks lower or not, but it's trying to find some stability. Now, digging into today's numbers, these are the wheat production numbers. USDA calling for a 1.877 billion bushel crop. And you'll see where that is versus the average trade estimate versus where USDA was the previous month. And then down here in the bottom row, you see where our INTL-FC stone estimates were. Crop came in a little bigger for all wheat than what we anticipated and certainly what the trade expected. We were closer than the trade. When you look at all winter wheat, we were bigger than bigger than the average trade guess, but we were a lot closer to USDA. I was quite a bit below USDA on a hard red winter. We saw an unexpected jump there. I expected a little bit of a pullback. Soft red winter, more of a pullback versus what the trade expected or versus what I expected. When we look at white winter wheat, 232 million is what I expected. The trade was at 230 and USDA at 236 million bushels. Hard red spring wheat, I was at 599, down 15 million from USDA last month. The trade was at 601, just above where I was at, and USDA came in at 583. So the hard red spring crop, much smaller than what was expected. We're actually hearing good yields and a little bit surprised based on the yield reports that we're hearing through the first quarter or so of the harvest. And of course, durum at 73 million bushels there. Okay, so if we look at, this is the change from the July report. We see that most of the Midwest saw wheat yields drop. Texas went up a bushel, no change in the Central Plains. We did see the reduction in the Northern Plains, increases in the Pacific Northwest. And of course, much of the soft red winter wheat belt saw declines. If we look at the objective data here, we see that USDA showing fairly low head counts out there, but fairly heavy heads. Now, of course, the weight of the heads is implied. They take yield divided by the head count to get implied weight. The record was set in 2017. 2016 was very similar to what we saw this year. If we look at the wheat balance sheet, the left column here we see is the 2017-18 marketing year. 18-19, the current crop marketing year is right here. Then you see my old crop 17-18 and you see my new crop 18-19. I did not change. These are the estimates that I prepared before the USDA crop report. Here's what today's USDA numbers were. I did not change my numbers so that you could get a feel for what numbers I took into the crop report. And basically it comes down to USDA is much more optimistic on feed usage than what I am. USDA went up 50 million bushels on exports. I was already 25 million ahead of them. I'm a little bit reluctant to go that high yet, although I think it's very possible, but I want to see USDA lower their Australian production estimate yet before I go any higher. Right now, we're significantly below the export pace, but we are looking for an active export campaign in the second half of the marketing year. Winter wheat stocks are declining. Hard red spring wheat stocks are still increasing, as we see here over what we've seen the last couple of years. Virtually everything else is decreasing. But even if you look at all wheat stocks, hard red spring, hard red winter, and soft red winter, all at 5, 6 over 5 to 6 month supplies of wheat. So we have big supplies of wheat yet carried over from last year that are creating some problems. I do think that we'll see those work lower, as USDA is counting on, basically as Ukraine and Russia start limiting exports later this year. Europe has limited exportable quality wheat, and then that should boost ours, Australia as well. Now, let's shift gears to corn and soybeans and spend most of the rest of the time talking about corn and soybeans. We see USDA's yields at 178.4 for corn, 51.6 for soybeans. Obviously, that's well above where the trade was at and well above where USDA was at last month. It is very close to where our client survey came out. So our clients who are out there in the webinar today, I want to say thank you to you and also to Bevan on our team who put together all those results. It's kind of like making sausage. It's kind of messy, but he did a good job once again. And just reminds me a lot of 2 years ago when our August number surprised everybody and kind of got laughed at because it was high, and then turned out to be pretty close to where the crop ended up being and close to USDA. And that's the case once again. These are big crops. And I think that if the corn number had come in closer to where trade was expecting, or soybean number certainly, obviously we wouldn't have had the reaction we did. But I think the big bearish factor here that eventually pulled corn and wheat under was that soybean number. Trade just simply wasn't prepared for that when we're in the middle of a trade war. When we look at the impact on the ending stocks, this is why I said what I said. 1.684 billion bushels is a fairly tight supply. It's a little over a 40-day supply. That's really not all that much. There's not much room for error there. When we look at soybeans at 785 million, that's almost 800 million bushels. That's a lot of soybeans, particularly when we're in a trade war. So I can't blame the funds for selling that off, allowing the momentum to carry them down and kind of continue to hit the sell stops. Wheat at 935 million is a lot of wheat too, but that's down considerably from where we were. Just doing the numbers in my head, that's almost 20% down from a year ago numbers where we were at 1.1 billion bushels. So we are moving in the right direction for both corn and soybeans. Stocks year on year are moving significantly lower in corn, and I said corn and soybeans, corn and wheat. It's soybeans that are going up. So now the market has got to sort out what it's going to do for soybeans versus corn. And basically, what these numbers suggest is we need to worry about wheat acres this year, although I think from what we're seeing, and we're surveying our clients now, and we'll have those numbers here by the end of the month on what winter wheat acres are going to do for this next year, but we're looking for an increase in winter wheat acres. The market, though, needs to buy more corn acres in the world at the expense of soybean acres. So the market needs to move in that direction to do so. And of course, the next soybean crop gets planted starting here on September 15th in Brazil. So not much time to really impact that. Now, if we look at world stocks, all of them going up from where we were a month ago. We here again were one of the closer estimates on the corn side and on the soybean side, although they were considerably higher than what we were at. When we look at, and I've been saying all through 2018 that, well, I thought USDA, particularly from May forward, was understating demand. Well, I'd say particularly from June forward, understating demand. I still have struggled to build a bullish story on soybeans. I still see a strong story longer term for corn, and we'll go into a little bit of that later. I do think that USDA still has some upward revisions to make on the world corn stocks when they get a more realistic size of China's reserve built into their balance sheet. Now, when are they going to do that? I don't know. I will say that based on history, September or October crop report, I'd lean more toward the October, but it could be September. Those are two opportunities where USDA may do that. they may need to add up to 100 million metric tons to that. And you think, wow, that's bearish. And the market will likely say it's bearish initially. But once we get that reserve in there, then we can start seeing how rapidly it's coming down. USDA has China's crop at a little over 250 million metric tons, this year's corn crop, in demand at 225 million metric tons. But China came out and revised their numbers this week. China saying it's a 216 million metric ton crop. And they say the demand is 45 million metric tons above that. So the deficit of production under demand is about 45 million metric tons, and that's up over 20 million metric tons from last year. So the deficit is rapidly growing from year to year. And so once that reserve is used up, then the world's got to already have more corn planted in order to meet that demand. And so, and China's just now ramping up their ethanol production. Their report said that feed usage was up, I think, 8.8%, industrial or ethanol usage up 13.3%, and that's just continuing to build. So the world's going to have to produce more corn to meet that. And right now, the market is not doing what it needs to do to encourage that expansion in production. We don't know at what point China will say, stop pulling corn from the reserve is low enough, it's time to start importing. We don't know that. We don't know how low they're willing to let that go. We will say that most of the corn now, they've used up most of 2013, 2014 reserves, and they're down now to the 2015 reserves. And 2015, if you recall, was a very wet year. A lot of corn is believed to have gone into that reserve wet. And now that they're really starting to sell that corn, the auctions aren't going very well. And to us, that tells us that that corn has some real quality issues. So this is going to be interesting to watch. Now, we have seen Dalian soybean prices start to rally significantly here in recent weeks as the market there. China is saying, we've got plenty of supplies of protein. The market's saying, no, we don't. They're suddenly realizing Brazil's about to run out. So this is a concern. I'll talk more about the trade war a little bit later. At 178.4, you see it there relative to the trend. If we look at from the previous year, those corn yields, a big increase in Nebraska and the Dakotas where the drought was big last year. Also an increase in the eastern Midwest and up into Wisconsin. But a decrease most other places from last year. Missouri, where the crop is really looking poor, I think our yield model is around 122.8 for Missouri, although that's a brand new yield model and we're still testing it out on the state. USDA coming down to 131, but I'm saying that to say that USDA may come down a little bit more yet on Missouri. But look at Illinois, 207 bushels per acre, up 6 from last year. Iowa at 202. This is a big crop, and there are problems out there. There are portions of Illinois that have problems, portions of Iowa, and certainly southwest Minnesota that have problems. Some excessively wet there. Illinois, some areas too dry, but yet there's a lot of good corn out there. If we look at the corn, basically we're looking at record ear populations. So that's how we got the big yield, is the record ear populations and near record ear weight. And that's an implied ear weight yet at this point, but near record ear weight. If we look at USDA's production estimate, that's signified by the big red block or square that we see here. And what's circled is our estimate just below that. So you can see how close we came. There was one other estimate that was closer than us, just above them. Otherwise, we were the closest estimate out there. Thank you, Bevan, and your work and all the clients who contributed to that. As we look at where do we go from here, of course, the crop condition index score is still well above the 10-year average, declining down seasonally. You see here where that index score is for this year versus all the last 31 years. that USDA's been giving crop ratings, and then versus the final yield in each of those years. If we look at our corn ethanol usage, it is strong. We did fall below average here this spring. Now we're back above average and near record levels. This last week, ethanol production was at almost a record high level. So we're using, I think we used 113 million bushels of corn, that's estimated this last week. Livestock's using a similar weekly total. And then you look at exports at around 50 million bushels. So that says that we got to pull about 275 million bushels a week through the supply pipeline. That's a lot of corn. We look at export shipments here. They've been above this seasonal pace that is needed in order to hit the USDA's target. So I still believe USDA will have to raise that target a little bit more for the old crop. Chinese corn days of supply, I do think this is going to have to be revised upward because of the size of reserve. But look at this, regardless of what the size is, it is still trending down at a fast pace. And so eventually it's going to run out. World corn days of supply is at 52 days. But if you take out China, United States, it's at a tight 38-day supply, tighter than what we were a few years back when we had record corn prices. If we look at the corn balance sheet, here again, old crop 17-18 marketing year from USDA, new crop from USDA balance sheet. My old crop, I have a little tighter stocks because I'm looking for exports to go up a little bit more. I'm looking for ethanol to go up a little bit more. My new crop balance sheet, notice that I had our yield of 178.1 in and USDA 178.4. I did not change my numbers. And so I come out with an ending stocks of 1.754. I am a little bit lower now than USDA on feed after USDA went up 100 million bushels on feed usage. USDA also went up 125 million bushels on exports. I am not that aggressive on new crop exports. If we see more reductions in the Black Sea as well as South America, I might consider it, but I'm not that high yet. That's why I have a higher ending stocks. But even at that, look, it would justify a marketing year average cash price of 405 per bushel. 45 cents above USDA. Here in the lower right-hand corner, I have a price regression analysis of the 2000s here. And if you go back and look, every one of these years I put on here where we came out price versus stocks as a percent of usage, every time it was above the line was a year that the funds were bullish at commodities. Every time it was below was a time when they were bearish at commodities. And right now, in the short run, they're bearish at commodities, but we're still in a longer-term uptrend worried about commodity inflation. USDA's price estimates this far out usually tend to be right on this line or right close to this line. But yet that would suggest, or USDA's current fundamentals would suggest a marketing year average cash price of 425. I'm at 405, but USDA's actually down here at 360. So they're considerably more pessimistic than what their analysis in the past should have shown. And so we'll have to see if the market eventually does come back up and trade as it has in the past. Excuse me. Soybean yield, you can see there well above trend. Export shipments of soybeans have been very strong this summer relative to the typical pace that we see in the summertime. You can see here Chinese soybean demand was increasing at exponential rates, but it started to slow. The rate of growth has started to slow, and imports are flattening out as China has more ethanol DDGs in order to use for a protein source. Crush is strong this year due to Argentina not being able to hit its, Argentina is the world's largest exporter of soy meal, not able to keep the pace this year, and so we're doing a lot more soy meal production and exports. Here we see the soybean condition ratings. took that big unexpected downturn here this last week. The question is where we go from here. Keep in mind this crop report estimate was as of August 1st. So ratings have gone down since August 1st. And according to my yield models, we lost 1/3 of a bushel. If that applies to USDA's number, then that would suggest that we're closer to 51.1 or so now after a decline in ratings. So starting to work its way lower. We'll see what we do over the next couple of weeks. Soybeans, here again, USDA's old crop, USDA's new crop, my old crop, my new crop, and I did not change this after the USDA report. USDA is at 785 million bushels for ending stock, some at 657. Notice our yields are very similar. Differences are exports. I'm considerably stronger in exports than what USDA is as I look at balance sheet. I see a little bit better demand picture. I think USDA has gone overly bearish even with the trade war. USDA is actually a little bit more aggressive on crush than what I am. And frankly, after looking at some of the latest data on crush capacity, it's possible that I'm too conservative on crush numbers, that I really think that as Argentina gets back closer to normal production, that they're going to be grabbing a lot of that market share back. Okay, this graphic on the right represents rainfall for the Midwest Corn Belt, the Corn Belt overall in the United States for the last 30 days relative to normal. And you can see that in the Western Central Plains, we've had above normal rainfall, considerable amount of it. A lot of other places we've been below normal rainfall, a lot of problems in Iowa. Remember, USDA is Iowa at 202 and Illinois at 207 bushels per acre. This is the graphic for the same time period in 2017. Both years, the period averaged below normal temperatures. 2017 was actually a little bit cooler than 2018, but pretty close. But during that 30-day window, I know it was warmer before and at the very beginning of that, but during that 30-day window, both of them averaged below normal on temperatures as well as below normal on precipitation. This is the quick response drought index, and you can see where we're most vulnerable for drought is in eastern Kansas and Missouri and some areas of the northeastern Midwest. Crop corn growing degree days well above normal from May 1st to the 11th of July. That was kind of the cutoff when the heat broke. Above normal nighttime temperatures were a major factor. And that also helps speed up soybeans. Soybeans tend to be day length sensitive. When the day length starts to shorten or the night length starts to increase, tends to trigger a hormone change in the soybean plant, which makes it go reproductive. Warm nighttime temperatures we're finding out, and I credit Dr. Knopfitzer from University of Illinois with helping bring me to this understanding, because as an agronomist, this was in a former life, this was puzzling me a little bit. So he gave me a great explanation. That helps speed up the process. So we saw soybeans go reproductive this year well before they normally would have. We don't know for sure if that means earlier maturity. If not, that would be big for yields. We tend to think, though, based on what we're seeing to this point in the field, that it is speeding up maturity, and so less of an impact on yield right there. So earlier corn harvest looks for sure, weather permitting. Earlier soybean harvest also looks likely, but less confident in that. If we go after July 11th, we see that, this is nighttime temperatures, and you can see particularly June 30th to July 11th, when we were in a pollination phase, above normal nighttime temperatures. This graphic here is from 2010. This graphic's from 2011. Nighttime temperatures were a big factor in those 2 years. Now, if we look at total corn growing degree day units, from July 12th on forward, and this is to August 9th when I had to put this graphic in here and prepare this graphic. You can see that we were below normal on GDDs for the bulk of the Midwest during that period of time, modestly below normal. Weather forecast going forward from Commodity Weather Group, above normal temperatures in the north. That slides off as the high goes east, and temperatures moderate as we go later in the 15-day period. Rainfall, I see the northern half of the Midwest, particularly northwestern half of the Midwest, looks to continue to have some problems on rainfall. And southeastern Midwest does better. Some good rains in the southern plains, which certainly should help the winter wheat planting if we get enough to hold on till September when the planting happens. Certainly something we're going to have to watch. But what's really concerning here is that dryness in the northwestern, I'm going to say 2/3 of the Midwest, which could start impacting how we finish the crops. South America, summer growing season coming up. And so basically this graphic shows we may be hotter than normal, particularly in the northern half of the Brazil's soybean belt, corn and soybean belt. But the odds of a problem right now seem to be pretty low at this point. So pointing to some good yields. We do think that we may have a lingering dry problem, which may delay planting. And if planting gets delayed, that could cut into the safrinha corn acreage. We're already expecting we may see a reduction in safrinha corn acreage. So here again, that means the United States is what needs to increase corn acres. Excuse me. Okay. Let's talk trade. I like this graphic. Dr. Rory Deverell in our Dublin office put it together, and I think he did a real good job. I asked him if I could use it, really showing some of the trade patterns we see in the world. And you can come back to watch this on demand and go through and study these slides a little bit closer. Feel free to do that later today, not immediately, but later today. Jake will certainly have that up there. Jake and Sean, we appreciate their help in producing these. They'll be posting this on demand, so you can take a look at this once again and study these slides more. This graphic shows who our major export customers are. And it starts with Canada, followed by Mexico, followed by Japan. Who are we having our biggest trade spats with right now? Japan is number 4, and who is in Washington this week to negotiate with us? Well, Mexico is, and Japan is. We're just getting started with Japan. Mexico, the word is we're making some significant progress. China is not talking too much right now, and Canada's on the sideline. Keep in mind that the first NAFTA came with an agreement with one of those two countries. If memory serves me correct, I think it was Canada, and then we went to Mexico and they signed on. The thinking is now we'll get an agreement here fairly soon with Mexico, and then we'll go to Canada and say, you want to sign on. Imports, well, it's kind of the same players, change the order a little bit. 22% of our imports come out of China. That's why it's a big deal, and that's why we've got a lot of items we can put a tariff on. Versus the fewer, smaller number of items that China could put tariffs on in this battle. Here is a list of Canadian tariffs. The left-hand column is our most favored nation status tariffs, and you can see they put tariffs on a lot of ag things. Notice yogurt here, and that's how we would export dairy to them. So in essence, dairy products would be 237.5% tariff for most favored nation status. They're really blocking that, and now they've put another 10% surtax on top of that. Mexico tariffs, far more reasonable until the trade war started, and now they put a 20% on. That's the right-hand column. The thing that's impacted the most so far has been pork products. And China. Prior to this trade war started, we paid this most favored nation tax on virtually everything. uncombed cotton is one of the exceptions. Then a value-added tax. For some products like soybeans, we pay the 10% value-added tax, and then it gets reimbursed again after they produce the meal. A lot of the other products, though, that aren't processed in the same way don't see that reimbursement. So really, you're looking at the 25% retaliatory plus the 3% most favored nation. So you're looking at a 28% tax right now for soybeans, 26 for corn, etc. So the bottom line I want to show is DDGs. Look at this huge anti-dumping tax that they put on DDGs, really shutting off the flow of U.S. DDGs to China. That's on top of the 5% MFN tax and a 10% value-added tax. The 5% goes on top of the 25% retaliatory. China's been doing this for a long, long time. They like to sound innocent, but they're far from innocent. Reese Frizzell on our staff, who's also helping with today's production of the webinar, put together this graphic that I thought did a good job of showing how the price of soybeans moving toward China changed with the 25% retaliatory tariff. We also include freight costs here and currency exchange rates. Chinese buying Brazilian soybeans is certainly costing them money now since the trade war started. Okay, economic growth. Granted, we had, what was it, 4.1% growth in the last quarter over previous quarter. On an annualized basis, though, we're at 2.8%, and that's expected to climb up to about 3% this year. The big thing is to notice the trend higher toward greater growth in our economy. If we look at, and of course, back here is the recession that we had a little over a decade ago. If we look at China's economy, of course, big growth in emerging nation isn't unusual, but look how it's trended lower. But look also how flat it's gotten over the last several years. And not much volatility. That's just unusual to have that flat of GDP numbers. And that suggests to a lot of observers, including myself, that these numbers aren't real, that they're made up by China in order to make things look good. And so that's why I said the very fact that they're reportedly taking the tariff off of U.S. crude oil imports tells me that they're desperate to find some stimulus for their economy. Now, the top graphic is a question that I put out on Twitter, which is a non-scientific way to poll producers. Last month on what do you expect corn yields to do? And notice that 33% expected above trend, 41% below trend, at trend, and 26% below trend. So the bias was toward a good crop yields. And that's what we saw today. The lower question is a question we had, what do you expect? That was for corn. On soybeans, the bias was that we would see an at or below trend soybean yield. Well, less than a quarter thought we'd see a higher soybean yield. So the bias was the corn crop looks good. It's going to be a big corn crop a month ago, but the soybean crop is going to be below trend. Today kind of shot that to pieces. Our Twitter survey this time around took a look at the trade war specifically. The first question is, has this current trade dispute with China changed your marketing approach to corn and soybeans? And really, people were pretty evenly split, 44 versus 46%. That's within the margin of error. About half of the farmers saying, yeah, it has impacted how I market, and about half saying, no, it really hasn't. There's not a lot I can do about it. It really hasn't impacted it. Now, then the next question we asked is, how long do you expect this trade dispute to last? And 15% said it'll be over in a few weeks. 42% said a few more months, and 43% said this is going to continue well into next year. So you put that together between a few more months and well into next year, farmers are really expecting this trade war to go on for a while. They're really prepared for that. They did a lot of selling on the spring's rally, and they're really prepared for this thing to last for a while. So wrapping it up, our take-home points, and then you can be entering your questions there on your screen, and Jake will read them back to me, and we'll try to answer as many as what we have time for. Global corn demand is strong, but the current supply is ample. Because of that current supply and size of the crop, it gives the bears a little bit of leeway right now to push the market down. Global corn demand, though, is strong, and outside of China, the rest of the world's pretty much on a just-in-time supply basis. So, in the next point is the market needs to encourage expansion of acreage in 2019. At some point, it needs to do that. If it doesn't in 2019, it's certainly going to increase the need for 2020. Soybean stocks are burdensome. The market needs to encourage a reduction in 2019 planted acres, starting with Brazil. It's a small world wheat crop and a small crop that gets smaller, but the benefits of that smaller crop on the price look to be several months away because current supplies are more than adequate. U.S. wheat acreage, though, is expected to expand in 2019. The trade war cloud maintains uncertainty, keeping the bulls conscious. So with that, I will open it up to questions. And Jake, are you the one reading the questions? If so, why don't you let us know what you got?
Thanks, Arlan. We got a question from Kevin. Do you have an educated guess on how large or short position the managed money or the speculative trader will take in the soybean futures market, also in the corn futures market?
Good question. That is something I did not have the time to develop some estimates on today after seeing the numbers, because I had to try to get this to compliance in time. So I haven't done that. I'm going to try to take a look at that and see if we can't post something. The funds had been continuing to build bearish, and I'm talking specifically about the speculative hedge funds. They've been continuing to build short positions on soybeans. They had been reducing short positions in corn. They're starting to rebuild them today, is what I anticipate the data is going to show. So they've got a lot of room there. They could significantly increase the shorts. I wouldn't be surprised if they would build toward a record large short position in soybeans, trying to discourage production, encourage demand, trying to bring that spread between U.S. and Brazilian soybeans down to a point where it'd be profitable for the Chinese end user to go ahead and buy U.S. soybeans. Corn, I don't think they'll do that. I think once things settle down, the dust settles down, and we get a feel for what the size of this corn crop really is, and I think we're close to that. I think we'll see the corn, the funds come back in the corn market, and the selling interest is going to be somewhat limited by that. Next question.
Miguel wants to know, what is a farmer doing to be ready for the trade war?
Our surveys in the past have shown that the farmer's not doing much. Now, the survey I just showed you says it is impacting about half the farmer's marketing plan or their approach to marketing. We did not ask how it's changing yet, but having worked with farmers for much of my lifetime, I anticipate that what they're doing is being a little bit quicker to sell rallies. And I think we're seeing that too on some of these price rallies. Farmers selling seems to be a little bit quicker than what they otherwise would have sold. What they really need to be looking at is opportunity to protect equity. And even though soybeans is the big crop impacted here, the trade war sentiment has hurt corn and wheat prices as well. And prior to today, you look at the new crop prices for July of next year, and there was opportunities in many cases to lock in profits, and we were seeing farmers do that. So that's kind of the mentality that farmers have to be considering, is that at what level and at what time can I lock in some profits to protect my equity? That's going to vary from farm to farm.
We have a question from Norm. What kind of range do you see the corn market between now and November 15th?
Oh, that range could be significant, depending on if we see progress on a trade war. What I didn't say, and this reminds me of it, is I'm expecting, and a lot of hinges here on the China trade war. If China can hold out, I expect them to try to hold out for the midterm elections. They're hoping beyond hope that the Republicans will lose Congress in this midterm election, essentially taking the power and support away from President Trump on this trade war. And so I think they're going to do everything they can to wait till after the midterm elections. And then I expect an agreement in November or December with China. What kind of agreement depends on whether the Republicans hold on to Congress or not. If they do hold on to Congress, I think we'll get some major concessions on private property rights. Intellectual property rights is the better way to say that. But I think we'll also get some significant boost in commodity purchases, including energy, like crude oil, liquefied natural gas, as well as corn. That's if the Republicans hang on to Congress. If the Republicans do not hang on to Congress, I think we'll get a trade agreement in November or December. We'll get some good boosting of demand for energies of crude oil and liquefied natural gas, but also for corn, I believe. But we won't get the intellectual property rights. I don't have any inside track on what's happening, in the talks. That's my analysis of the politics and the dynamics of this. So what kind of trading range? That's stretching what compliance is going to let me say at this point. So I guess that kind of looks like a weasel out. But I am limited in what I can say on price movement. I do think, though, with fear and greed working on the trade war situation right now, prepare for anything. Manage your risk exposure. Prepare for the possibility of anything happening in this type of environment, which means, I guess I'm saying, is we could have some considerable bandwidth in the price range that's traded.
Thanks, Arlan. You kind of covered this, but when do you think that China will start importing corn?
Prior to the trade war, and I don't think it's traded that much, but changed it that much. Prior to the trade war, I was saying that I felt like it would probably happen sometime in the third or fourth quarter of the 18-19 marketing year. So that would put it sometime late spring or summer of next year when they would. Now, they're still looking for imports of around 3 million metric tons like what they did this year. But we're talking more significant numbers, a more significant ramping up of their export program, probably in that time frame. It really comes back to how comfortable are they. If those 2015 corn stocks are as bad as what maybe they are, it might have to be sooner, which would put some pressure on China to lower that tariff, that retaliatory tariff, or to get an agreement.
Question from Keith. Your thoughts on wheat production numbers in Canada, Australia, Russia, Ukraine? USDA did not change these numbers versus market reports.
Yeah, they lowered Europe, what was it, 7.5 million metric tons roughly. And that was really the bulk of the change they made, other than changing US because of a smaller hard red spring crop. Excuse me. If you look at Russia, I think they're at 68. I think that's probably pretty close. I think the Ukraine number may be pretty close. On Australia, they're at 22 million metric tons. And I think that comes down, what we're hearing from Australia, somewhere in the 18 to 20, with maybe a little bit more of a bias toward the 18 or 19 million metric ton range. Canada, don't really have a feel yet. This is a critical time for them right now, as they're facing some dryness and some heat stress coming on here during the grain fill period of time. So I would anticipate we're going to be putting some downward pressure there, but I really don't have any good information yet coming out of Canada on how significant of a loss that might be.
Would a free trade deal with Europe have a significant impact on soybean demand?
I don't think so. I really don't think so, because Europe has bought most of their soybeans, and about 2/3 of their soybeans. The demand is 14.5, 15 million metric tons a year, and about a third of that they buy from the United States when they couldn't get it out of South America. The rest of it they would get from South America, and that had more to do, I think, with not liking our GMOs. And some would argue that that's another trade restriction that they need to get rid of. So I suppose if you could get a trade agreement that would remove their ability to block based on GMOs, that would significantly improve our exports to Europe. But frankly, I'm not that encouraged, not that optimistic that's going to happen anytime soon with Europe. They are going to be forced to take more soybeans from us this year. But beyond this year, I think they'll be back to buying from South America again, the majority of their soybeans.
We got one more. What's the result of the faster maturity on yield and kernel depth in corn?
We have done some studying on this, and what matters is the length of grain fill period of time. It's not the earliness of pollination. So when you're thinking faster maturity, you look at pollination date, you look at black layer date, or when it reaches maturity. And as we've looked at it, the date of pollination, the date of black layer really doesn't make much difference. But the difference in time between those two does. The longer that period of time is, the more it helps yield. The shorter it is, the more it hurts yield. And last year, we got this big unexpected yield bump, and the crop ratings didn't pick this up because they're subjectively looking at what does the crop look like. And you really couldn't tell this from the field, but the crop reached maturity maybe 3 days early, reached pollination about 3 days early. And then it turned off cool, and we didn't have a frost until well in October. And so we had a very long grain fill period of time, and we packed a lot of starches on those ears. We had some places where tip pullback was significant, even missing kernels from bad pollination. But the kernels that were there got really big and lots of starches packed into them, and we got these huge yields that weren't expected. This year, it looked like maybe a similar scenario, except for the crop's about 15 days ahead of normal. So when we hit that cool spell in the last half of July, the crop was already well advanced. And so that reduced the amount of time that cool weather could lengthen the grain fill period of time. So we got some benefit from that coolness, but not near as much as what we did last year. So the question is then, is 178.4, is that the high? Could it go higher? My bias right now is that it'll probably go lower, and that's because that the weather forecast from this point forward really leans more warm and dry, particularly for central and northwestern areas of the Midwest. So my bias is that the 178.4 is the high watermark on yield for corn. And if that's the case, perhaps so on soybeans as well. But soybeans is a little bit more of a guessing game. Do we really know? Are we really confident in the 51.5 or 6? Because this time of year, any private tour isn't going to be estimating yield. They're going to be counting pods, reporting pod numbers, not yield, because soybeans are that hard to estimate. So any other questions that came in, Jake, while I was answering that?
Norm wants to thank you for all the great information.
Well, thank you, Norm. We really appreciate it, and really appreciate all of you who have participated, and those of you who are watching on demand as well, who are coming up later today and in days ahead. And we'll be back with you next month. This really sets the table for an interesting crop report in September, and we look forward to being back with you then. I believe it's on September the 12th, and just really appreciate you being here today. And Appreciate Reese and Jake helping me out today and putting this webinar on. And good luck out there, and be careful as we approach this year's harvest.